All right, welcome once again. So we are doing company valuations today. So we are going to start off the session by going through, I think, the most important theory part. I just, what's the English word for that? I think it's to civil. Yeah, I believe that's the word. I basically only took what's important and I believe what's going to be relevant for our module, right? Just for our understanding of company valuation so that we can make use of it in our examinations. So these are the notes, and then towards the end of the class, we'll then go through a couple of examples. Right, we'll go through a couple of examples, and then take note again. Like I always emphasize that what's important here.
Please.
The principle.
Sorry.
The principle is what's very important here. So you need to be following through on the principle why we are doing certain things that we are doing, so that when you apply them, you are allowed to apply them differently in your own way, in your own understanding, the way you understand the question. Right? That's the whole point of this here. So to start it off, we normally use three methods here to do our evaluations. And just a background on this, I think maybe if you are doing MAC 37661, you might have done this on the test already. I can't remember what was on the assignment for MAC 3702. Probably you had this as well in the test. But the background behind, the background on what we were doing, right, in whatever we were doing there, or whatever we will do when it comes to company valuations, is a scenario where an unlisted company, you are basically trying to find the value of an unlisted company, right? That's what we are basically trying to do. Why unlisted? So with a listed company, finding the value of a listed company is very easy because you can simply go and just go to the internet, just go on the internet and you can look it up. You can basically find the value per share. I think we've done that when we're looking at the market value of shares, right, or the market value of a company, where we're multiplying the market value, which is the quoted price, which is the price that you find on the JSE there, and you're multiplying it by the number of shares that are outstanding, which is the number of shares that the company has issued, right? So that will basically give you the market value of the share. So if you want to buy that company or a certain company that's listed and you want to know how much you are going to pay, so you are basically going to be looking at somewhere within that range, somewhere in that range, right? Most likely that's what you're doing anyway. You can simply purchase the shares from the stock market. So you purchase for yourself ownership in that company. And then again, what kind of shares are you buying? You want to buy ordinary shares. Ordinary shares are the ones that give you ownership of a company. They give you part ownership of the company. So you are buying, when you are buying ordinary shares, you are buying equity in that company, right? That's what you are basically buying there. When we talk of preference shares, I think someone had a question on preference shares. I'm gonna check again. I think I'm gonna check in the group if he's available. I'm gonna call him out a little bit later. Was it you, Tumisan? I suspect it was you. I can't remember too well, but I think I'm gonna give you a chance to ask your question. I just didn't see that message. I only saw it today when I decided to go to the group and post some stuff there. All right, so ladies and gentlemen, this is the background of what we are doing today. Right, so we've got two different companies now, a company that's listed and a company that's unlisted. So a company that's not listed is basically a company that is not traded on the stock market. So those shares, you can't buy them on the stock market. Examples of such companies would be maybe your company and my company. They are not listed, right? If you want to buy those shares, then you need to perhaps go and knock at, I'll perhaps have to come and knock at your door, right? And then we can try and make an arrangement, right? Discuss around the price of your company, right? So what we are dealing with today in terms of company valuations, there is no need for us to talk about listed companies because we don't have to do calculations for those valuations. We only deal here with the valuations of unlisted companies because we don't have a ready market for those shares. So how much are those shares? So with a listed company, those shares are regulated by demand and supply. Right? So because we say they are liquid shares, right? It's a liquid investment, right? So those are traded. There is demand and supply, a direct demand and supply for those shares. So because the market is active, we are then able to easily determine the price there. All right. So I think the other gadget just got lost there. I'm gonna bring it back in now. Sorry about that, but we are still talking, so we are not missing anything. Yeah? We are not yet missing anything here. Right. So the kind of shares that we're dealing with are the shares that are not listed, right? For private companies, they are not listed. So we need to try and find the value of those shares, or decide what the value of those shares are based on estimates and certain calculations that we'll be running by tonight, right? That will help us to find the value of those shares. Right? Because there's going to be a situation where you are saying your company is worth a certain amount, and then the other one says, no, my company is worth a certain amount, and then in those cases they are back and forth. So we need, as financial managers, we need to come up with a method that can best estimate the value of these unlisted shares. So this is what we are basically doing. So we are dealing with a situation where, let's say, you want to invest in a company, you want to buy a company, and then before buying that company, you need to know the value of that company. So even if you are the one selling the company, you must at least have a rough estimate of how much this is worth. Otherwise, you obviously run the risk of selling it too low, right? Imagine you sell something to someone, and then you later on hear that they sold it times 5 the price that they gave you. That's very painful, right? So you want to be smart about that. So there are 3 methods that we basically use here, which I put them down. So it's the net asset value, this one here, and then the earnings multiples method, and then the discounted cash flows, which is the DCF method. So we basically make use of those 3 methods here. So if you are going to be asked, therefore, to find the value of a company, it's going to be either of these methods. All right. So what is the net asset value method? So here, the net asset value method basically calculates the value of the company by subtracting the total liabilities from the total assets. So this represents the net worth or equity. So remember, we're saying when we are buying a company or investing in a company, in terms of ownership, you are investing in the equity. You are buying equity, right? Which is going to be expressed in the ordinary shares. That's what you are basically doing. So how do you calculate your equity? Accounting students will know that it's basically your assets minus your liabilities. That will give you your equity. But the trick is, in accounting, they make use of, they say it's historical cost method. Normally, if you just pull out a set of financial statements, there is a likelihood that they are following through the historic cost method. So if you are just going to take a balance sheet or a statement of financial position and pull out your assets and your liabilities, you might come up with outdated valuations, right? Outdated numbers. So what you need to be careful for in this method is to watch out that you are going for the current values, right? Those of you who did accounting, you remember that sometimes, okay, in the normal case, if let's say you are selling a company that is not a going concern, so which is a company that is closing down, when you present financial statements for such companies, you normally use the current valuation, which is the liquidation value of those assets. So you forget how much you bought those assets for, but you want to concentrate on how much you can fetch out of those assets. That's basically what we're going to be taking into consideration in this method. So you find that maybe you've got buildings. Some of those buildings could have gained in value over time. So you want to look at the current value of that building. If you are to dispose of it today, how much are you going to fetch from that building? Right? Liabilities usually don't have an issue, because what you see on the balance sheet is normally what you get on the open market, right? So in terms of settling those liabilities. You don't expect that you are going to pay a lot more than what you borrowed based on the financial statements that we are seeing, right? So which means in carrying out this method, make sure that you want to adjust your assets to current values if ever those current values are allowed. So you are taking note of the fixed assets, which are the non-current assets. So you want to watch out if there are any fair value adjustments. So which is the case where we are dealing with a situation where the market value, current market value is different from the balance sheet value. Then you want to make that adjustment there before doing your deductions, right? And then in terms of your current assets, then watch out for inventories, right? Watch out for inventories, and then watch out for debtors also. Remember the distinction. You might not even get this here, but just for interest sake, you need to know the distinction between your non-current assets and your current assets, right? So for your non-current assets are your long-term assets, the ones that you expect to realize within a period that falls over 12 months, right? And then obviously if it's current, it's they will be converted into cash. You expect that they will be converted into cash within that 12-month period from the reporting date. You see. So debtors, some of those debtors could be bad debts, right? They could be credit losses, people that can't pay, right? So there's no point in you selling to someone a debt that you know cannot be recovered. You see, that there's really no point in that. And then sometimes inventories could have lost value, right? Sometimes inventories could have lost value as a result of maybe it has gone out of fashion, maybe the inventory was damaged in the warehouse. So you take all those things into consideration. So once you've totaled up your assets, you then deduct your liabilities. It will give you the value of your equity. So which is what the investor wants to buy then. So under what circumstances now can we use this method? So I think number one, it's more suitable if there is liquidation or distressed sales, right? If there is a liquidation. So when you are liquidating a company, you are basically closing down the company. So this company is not a going concern, right? So in other words, you don't expect continued existence, or you don't expect this company to continue trading. So which is why we are dealing with these, I earlier said, liquidation values of those assets. So which is what you are going to fetch when you sell those assets. So you are sort of like believing that, okay, it's over, guys. We are, it was nice doing business. This business is not running anymore. We need to close it down and we need to sell off assets. So now you're basically selling off the trucks, auctioning off trucks, something like that. So you're not buying a business or selling a business that's moving, right? You're basically selling a business that's dead now. So the only thing that you expect to get from that business, the assets, right? So I believe this is the first point. So it's very much suitable in these circumstances where the business is being liquidated. So it provides a flow of value indicating the minimum amount stakeholders can expect to receive. Right? This is what this gives us there. And then number two, it will be good in an asset intensive business. Right? So it's very suitable there. What kind of assets? Assets like real estate, right, where the value of tangible assets significantly contributes to the company's overall wealth, right? So that's where this method can also be very much suitable, because when you are dealing with assets, then you are going to your balance sheet basically to look at the assets that you have. So it works best where there's a lot of fixed assets, where the value of that company is based on fixed assets. Let me not say where there's a lot of fixed assets, because that could be deceiving a little bit. Let's look at a company like, say, McDonald's. Let's just say you own a McDonald's somewhere in some street corner, right? So when you decide to sell that McDonald's to someone else, there is more than just the chairs and what you find there, the cooking pots and utensils. that determine the value of that joint that you want to sell to someone. It's more than that. You see, the value of McDonald's is not determined a lot by its net asset value or by its asset structure in terms of real estate, etc. McDonald's has got to do with their brand name, right? Got to do with their bakers. You see, it's got to do with their staff and what have you. So when valuing a company like McDonald's, if you go and look at the value of those chairs there, it might mislead you. So which is why we are saying this would be suitable in an instance where the value of a business is derived from its assets, right? From its assets in terms of physical nature or tangible assets, as it were. So under those circumstances, that would basically work. So these two work hand in hand. And then, of course, investment funds. It's commonly used in the context of mutual funds and exchange-traded funds and other investment vehicles to determine the value of that particular share. Again, so this is a lot similar because these investment funds are also some sort of assets as well, right? And then in most cases, if you want to get the underlying value of those assets, then you want to look at the underlying value of those investment funds. Again, you might want to look at the assets that are backing up those investment funds. Sometimes it could be gold, sometimes it could be, God knows what it could be. All right. So, ladies and gentlemen, this is your net assets valuation method. Very simple and straightforward. So we'll look at examples much later after we've gone through this, but you can as well go through the notes again. I've provided them in the group. And then the next method, which is very common here with UNISA, is the earnings multiples method. Right? The earnings multiples method. This one is very, very, very common. You most likely, if it's a question on valuation, it's most likely going to be on this, and it will carry relatively significant marks. So the earnings multiples method involves using a multiple such as the price earnings ratio. So this is the one that we normally use here, the price earnings ratio. The other time I was in conversation with another lady who actually does these things for a living. She was saying they normally use this one here. In practice, this is the one that they normally use, right? For reasons that are obvious, right? Because we've discussed ratios before. And we've spoken about earnings, and we said earnings, remember when we're introducing ratios and we're saying these ratios basically come from, this is a ratio in any case, right? You could be asked to calculate this ratio. So this ratio, your price earnings ratio, basically makes use of your financial statements, right? And then in your financial statements, you are looking at this part here, which is earnings. And then we know for a fact that earnings can be manipulated. And then we also know that earnings take into consideration non-cash items, so which are maybe expenses and incomes that are not really expenses and incomes in the real sense. So which is why when these guys in practice use earnings before interest, tax, depreciation, and amortization, it makes sense for you to remove these subjective matters like depreciation and amortization, right? Because anyone can basically come up with figures on that, right? People can make intelligent guesses on that. So which is why in practice, maybe they would want to use this one. But here, it's simple for us. We are looking at the earnings. So your earnings is your profit after tax, right? That's what you are looking at. So this is your earnings are basically your earnings attributed to the owners of the company, right? Which is attributed to who? The equity shareholders. So remember, on part one, we were finding the value of equity. So which is why part two again, which is part B, we are still equity oriented. So which is why we are dealing with earnings, right? These here would normally be your free cash flows, but we will see again what we'll come up with there on part C. All right, so this is derived by comparing a financial metric, which is these here, with the market price. So this is what we just did here. right? So a financial metric is the earnings, for instance. It could be revenue, it could be your EBITDA, right? And then you are comparing that with the price. And then, so if you are using that now, they are comparable figures, right? Because you don't have the market price for the company that you are dealing with, right? What you don't have is the market price, but you have the earnings. So you are basically going to take the market price of a similar traded company, right? So you basically get the price earnings ratio of that company, and then you use it. You apply it on your own earnings to estimate the price or the value of your company. But we will see that in practice, right? When it's suitable, again, it's highly suitable when there is a comparable publicly traded company. So this company must be comparable. So in other words, it must be in the same industry, and then it must also have many other similarities besides just being in the same industry, right? So it must be a comparable company. So you must say, okay, had this company been listed, it would probably be, that other company. So it's often used in industries where there are very similar companies that can be used for benchmarking. So this comparing is benchmarking there. And then there's mature, profitable businesses, because we are using your earnings there. Right? It is effective for businesses with stable and predictable, which we normally refer to as maintained earnings. Right? Companies with a long track record of earning stability. So a long track record, obviously, we're looking at the past performance of the company. How has the company been performing, say, over the last 5 years, 15 years, right? So we can't use a situation where a company made a huge profit last year, and then this year they make a loss, next year they make a profit like that. Something that's unpredictable. A company that has basically not been in existence for a while. We can't really use this method there, right? But we'll deal with a situation where the profitability again is up and down, right? We'll deal with that, a zigzag situation. We'll see how we can deal with that situation here. And then the last method, the discounted cash flow method. So when we do that here for undergrad, it's very simple and straightforward. No stress on this one, and of which we have done a lot of things that are similar to this henceforth, so we are not going to have a problem. All right, so the DCF method, which is the discounted cash flow method, estimates the present value of future cash flow. So we all have seen present values, right? And we all have come to terms with cash flows, right? So this is basically what we are doing here. It involves forecasting future cash flows and discounting them back to their present value using a discounted rate. So this should ring a bell already, because we did project appraisal or investment appraisal. So this is when we're calculating our NPVs, this is the method that we are using here. Nothing different. There's just a slight difference there, which we will see. All right. When it's suitable, when you are able to project future cash flow. So in other words, you should be in a position where you can predict the future of the company. So I assume that you shouldn't be an outsider here, right? You must be someone that's within the management, and you've got access to these predictions, right? Tech startups and growth companies, right? It's commonly used for startups and high growth companies. So it would be good for companies that don't have a history, right? Remember, on earnings multiple, we were saying the company must have a history. Here you can deal with a company that doesn't have a history per se, because you're looking at the future, right? You're looking at the future. Remember, it involves forecasting future cash flow payments and then discounting them back using a suitable discounting factor. And then again, long-term investment. So you obviously want to buy a company that's moving, right? You're looking into the future. It's like when your friend approaches you and they want you to invest in their business. It might be in your best interest, if you're going to be a long-term investor, to look at the future cash flows of that company, right? So this is a good method for you to use, right? This would be a very good method, because it basically gives you an idea of where this company is going, right? In the sense that you are likely to be a part owner of this company, so it's important to you where the company is going. Then in discussing the disadvantages of these methods, right? Disadvantage of the net asset value method, obviously, it doesn't work, right? You're looking for situations where this is not suitable, right? Those are the disadvantages. So it will obviously not work for a company that's a going concern. It will give you fictitious figures. It will be misleading. It will basically give you misleading figures, not fictitious per se. And then the earnings multiple method, we already said, earnings are very subjective because of issues like depreciation and amortization. So these could be misleading. So I could pull up a set of financial statements with profits right out of my bag and give them to you and say, these are the profits that we've made. Profits do not mean cash flow, right? So you could make a profit and not have cash flow. So which could be a danger for the existence of the company. So particularly if you're going to be buying a company that you want to exist in the future, and then that wouldn't work. Discounted cash flow methods, you already know by now that the normal discounting factor, or the best discounting rate to use, would be or could be your weighted average cost of capital, right? It could be your weighted average cost of capital. But remember, those rates are very subjective, right? Look at your KE, right? Look at your cost of debt. Those are very, 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 very subjective, right? If you want to know how, if you wondered how we ever arrive at those amounts, if you look at, for instance, I think if you look at, let's say, your KE, using the Gordon's dividends growth method, for example, it's D, which is the next dividend. The next dividend divided by the market price per share plus your G, which is your growth. I think you remember this. You should remember this from the last class. But where does your G come from? And how guaranteed? Because we are saying your G, we expect that this growth rate is going to be maintained in the future, but who knows the future? And besides, you are projecting cash flow. So a lot of things could happen, including coronavirus, see, and we could get locked down anytime. So you can't be sure here. You can't be sure. You can't be sure with any of these methods anyway. But we are saying we want these things to give you a rough estimate so that when you go to the negotiating table, you are not blank, right? Someone shouldn't just come to you and say, this is worth $1 million, and you get excited. What if it's actually worth 3 million, 4 million, you see? So you want to have your own calculation on the side, and then let them also come. All right. So I think because I was in a hurry preparing this class, I didn't really get any questions from our module besides the ones that we already did. So the ones that maybe were in the assignments or in the test. So I didn't want to use those ones. But this one here has that question, I think. I believe I saw that question earlier today. Right? Very simple again. Don't be intimidated by these things. So here is the question here on 3.1. So I deliberately didn't share this so that you can pay attention, and then I'll share it after the class. I was fearing that if I send it before the class, people will complain and say, but this is honors. It's not 3.7 don't. Right? So they're asking us the same things here. Calculate the range of possible values Well-Tech Limited could place on health bar using the following valuation method. So we have net assets valuation, we discussed that earlier. Dividend valuation, which we didn't talk about, but we will talk about here, which is very similar to earnings valuation, right? And then that's on 3.1. That's basically what we're going to do. Then discuss the valuation methods, which we just did, right? There. And then in terms of commenting on their suitability, given the scenario there, if ever we get a question like that, then we are basically looking at those points where we're saying, under what circumstances is this method suitable? So here you are saying net asset method is suitable under these conditions, does it apply to this scenario? Dividend valuation is suitable under certain conditions again, which we will talk about. And then earnings again is suitable under certain conditions. And then on question 4, there is the other part which will end with calculate the value of equity. So this is 20 marks. I believe there's quite a lot to do on this one. So you will need to pay good attention on this one here. But very simple also. So if you are following, it will be easier for you to follow through while we do the calculations than when you are just presented with the solutions. So we'll work it out together. All right, so let's start off on question number 3, the net asset valuation method. So you want to quickly peruse through. Let me open my Excel sheet on the side here. So when you get the net asset method, you want to quickly peruse through, right, and see if there's a statement of financial position. So there we go, we have it. Where does the question start? The question starts here. So WellTech is a JSE listed company that specializes in wellness products. The company's directors are, can I have someone to assist me in reading, please? Anybody to assist me in reading?
WellTech Ltd is a Johannesburg Stock Exchange listed company that specializes in wellness product. The company's directors are considering making an offer to purchase an unlisted company, Health Bar Ltd, that manufacture a nutrition supplement product. Health Bar Ltd will continue operating as a going concern. As it currently is, should WellTech Ltd succeed with the purchase, the
All
extra...
right.
Okay, sure.
I think that's fine now. Perfect. So I've highlighted that now we are dealing with an unlisted company, and then it's expected to operate as a going concern. All right, that's fine. So now we have, so our first method is this one here now, the net asset valuation. So you want to go now to your statement of financial position, your balance sheet, this one here, and then you want to look at your assets, and then from your assets, you want to subtract your liabilities, right? But then we said, be careful, because sometimes the value of those assets is not reflective of the current value of those assets, of the assets, right? So you would want to make certain adjustments there. All right, so let me introduce it there on Excel. This typing takes a lot of time. All right, so we're on question number 3. So let's say 3A. Right, so I want to copy this and paste it and paste it that side. So we say it is 3.1A. Right, so we're using the net asset method there. So how you write it is up to you. This is 3 marks, so we shouldn't fight about on this one in terms of the presentation. So maybe just to, because we are learning, so I'm gonna go back there and take the items as they are. Right, we wanna take the assets as they are. So let's just say property, plant, and equipment. So I'm just copying it and pasting it that side, and then we'll put up the values. So I'm merely copying all the assets and then the liabilities. So once we are done with that, we look at the values and see if there are any adjustments that we need to make on those values. Then if we don't have any values, then we take the amounts as they are, simply do a deduction there, and then that should pretty much give us the answer. I believe it's very easy so far. So we have on the liabilities, we have got bank loans. What are liabilities, by the way? All right, I'm gonna put them, let's put them separately here, right? By the way, I'll emphasize again, you don't really have to present this the way I'm gonna present it here, no? Because there are many ways of killing a cat, but whatever method you choose, make sure that your work is at least understandable. It's something that even your own child, your own daughter can follow through. No? Like if you're giving a presentation, they must be able to see that, oh, okay, this is where this one is going, this is where. Remember how brilliant the last presentation was. That's what we expect you to do in the exam as well. Right? You keep up that high performance. All right, so these are the assets. So let me just show you what I did there. So I simply listed them. Right? I simply listed them there. So we're going to fill in the amounts here and see if there are any adjustments to make. So let's say these are assets. Okay. My keyboard is not typing properly. Right. These are assets there, and then on this other side you get your liabilities. Right. All right. So the value that you are going to get there would be your net assets. I'm sure you know the meaning of the word net. Right. Net assets, which you said this is equity. Right. This is just the same as equity. So let's go back to the question now and then try and fill this thing up as quickly as we can. So these are the amounts right there, but let's see if there are any adjustments there. Right, Health Bar is, these are the nominal shares, right? For Health Bar is a number of private. Let's just see if okay. All right, that's perfect. So Health Bar Private Limited has 10 rand, which is the nominal value of those shares, and has a number of private individual shareholders that own all the shares. The CEO is paid a salary, so there's nothing there on. So we want to zero in on issues that have got assets and liabilities. Right? Then included in the property, plant and equipment of Health Bar Limited is a property that is overvalued by 1.2 million. So there's already one red flag there. Right. So which means included here is an item that has been overvalued. So which means whatever we do there, we need to slash it down, right? We need to slash it down. So I'm simply putting in the figures there. Right. I'm gonna show you for the first one. So it's 9042, right? And then they said it's overvalued by how much? By 1,200, I believe. Let me just check that before we share. Yes, 1,200. So let me share what I'm doing there. Right, I was typing on the side, and this is what I was typing. So this is the value as per the balance sheet, but they are saying it's overvalued by 1.2. So we make that adjustment there. So which means the amount that goes in is 9042 minus 1,200. Right. Easy so far. Let's go back again and check if there's anything. So also included in the property, plant and equipment, which is currently operational and in use, is plant and equipment which is operational that are worth 1 million less than the current book value. Okay, so which means there we got excited too soon. Ne? So there is another deduction that goes in. So minus 1 million. All right. Okay, before I conclude that, let's check maybe there's something else, right? So we've done this one, and we've done 1.2, we've done 1,000. Then 350,000 of Health Bar inventory is old and obsolete and could be scrapped or could be sold as scrap for 70,000. Okay, so I think we are done with PPE. Right, let's make the adjustment there. Right, so there should be minus another 1,000 there. You see how easy this is so far. Right, let's adjust the inventory. Right, so they say the inventory. Let me take you to our starting point where we are checking the value of inventory. So our inventory as per the balance sheet is 1590 there, but they have an issue. They are saying 350 of that inventory is obsolete, and of which we can only get 70 out of that. So you remember that in any case, inventory should be valued at lower cost or net realizable value. So net realizable value is what you can get from that. So this is all that we can get on that inventory 70 from the 350. Right, so we do the adjustment again. So we take the amount as it is for inventory. It's 1590. All right, so we are taking 1590 and then deducting what? And then deducting 350 and adding 70. All right, so this is going to be 1590 minus 350 plus 70, because 70 is what we can get. So this inventory was valued at 350, so we need to remove them completely and then introduce the new value, which is 70 there. So which means this is going to be 1590 minus 350 plus 70. I don't think this will get any simpler than this. This is very, very, very simple. See, there is nothing else. We have exhausted that. So which means the rest of these, we want to put them as they are. All right, so the receivables, there is no change. So sometimes with receivables, you want to watch out. They might say there could be an adjustment on your credit losses or your allowance for credit losses provision or bad debts, right? There could be an adjustment there. So if there's an adjustment, you simply put it through there. So the rest of the amounts, they are as they are. There are no changes there. And then the bank loan was 5548. Let me put it as negative 5548. And then the current liabilities was 3410. Let's put it as negative 3410. All right. And then here we are simply doing the maths. So what I like about this particular method that I chose here is it basically allows you to show the calculations, because this is principle here. This is a matter of principle. Anyone can add and subtract, right? But doing this here, you are displaying your understanding of the principle that, okay, you didn't simply deduct 1.2 or 1,000 out of the blue, but it's specific to your PPE. So which is why I would ideally go for a method like this, because it helps you display your understanding of the concept. You see, so once you've displayed your understanding of the concept, then you are bound to get a majority of the marks. And guess how many marks we are dealing with here today? We are only dealing with 3 marks, unfortunately. But maybe for undergrad, they could give you 4, 5. I don't know. Right, and then the dividend valuation method. So this one is one method that we did not mention or that we did not talk about. But this is closely linked with what? With the Gordon's dividend growth method. Right, it's very similar to that. Remember, that method helps you to find the value per share again. Right? Not only does it give you your KE, but you can flip the formula around to get your P, which is the value per share in the given circumstance. So we want to do that now. Right, let's see how we can, let me copy that, and then we see how we can go about that one. And then under what circumstances is such a method used? So this method would be suitable when the primary goal of the investor is dividends, right? When your primary goal is dividends. So what kind of investor are you? Maybe you are an investor that's not quite interested in the long-term viability of the company. You simply want to get earnings, right? You simply want to get earnings in terms of dividends. So you are opposed to someone like Elon Musk, who's not chasing after dividends, right? They are chasing after the growth of the company, where they can simply say, you hear that Elon Musk is worth 500 million. Most of that is coming from the value of those shares, right? So you would be an investor with a different approach there. Right, so which means in this method, as I've already indicated now, you want to look for your dividends to assist you in getting the price, right? So let's see what they are saying, if there's anything that is said on dividends. Okay, there we go. So we've got these dividends so far. So let me just check what year we are on. We are on 2022. Okay, so these are the dividends so far, and then let's see what stories are there on the dividends, what they've got to say on the dividends. All right, so far now we have okay, the company has 40 million ordinary shares in issue where the shares are currently trading at. So this is a comparable company. And then WellTech has a net profit of 65 million. So this one we're going to make use of. A suitable cost of equity for health bar is going to be 15%, right? So which means our KE, right? Our KE is 15%. That's what we need so far. Right, then let's read around and see what else is spoken about in terms of dividends. Right, so the directors, they want to make an offer, and then this is a going concern to succeed right there. Okay, all right, and then we have our dividends there. All right, nothing else, nothing else, nothing else. All right, so ideally, what you would do, right, what you would do in a situation like this, right, because what you need now is the growth rate. It's the only thing that's missing there, is the growth rate. So what you could do to get the growth rate would be assuming that these dividends are expected to grow in the same. So for us, normally they would mention it, right? They would mention it that these dividends are going to grow in line with how they. Okay, so sorry about that. Okay, so in these circumstances, therefore, you want to look at, right, I would say you might want to look at, all right, I would advise that you look at the average growth rates there, right? You want to look at the average growth rate, and then I'm going to show you how you can get that, right? We've seen such questions, particularly on MAC 3702, where you need to find the average growth rate, because we are not specifically told which one we should go for, right? So if you go for the last one between 2021 and 2022, you will get partial marks because the question is non-specific, but the correct thing to do when it's non-specific is to go for the average of all of those. So I'm going to list down these dividends now on the Excel, and then we calculate the average growth rates there. Right, you want to get the average growth rate. So let me say I'm going to type, so I know you can't see what I'm typing, but I'm going to show you shortly after that. So it's 2018, 2019, 2020, and then 2021. So I'm just going to simply list the dividends in those particular years. So it's 252, 276, and then maintained at 276, went to 340, and then in 2022 it was 369. So this is how you calculate the growth rate. For starters, let me share that with you. Right, so the growth rate you want to check now between 2018 and 2019. So you are taking the latest value minus the previous value divided by previous value. That's how you find any kind of growth rate. So the latest value there is going to be the 2019 value minus where it's coming from, which is the 2018 value, right? And then divided by the 2018 value. So that gives you 9.5%. And then you do the same for this one. What are you doing? the latest minus the previous divided by the previous, right? This is going to be a lot useful in your ratios again, right? So you do the same for all of those, and then these are the figures that you get there. Right, let's put them in percentages. Right, let's put them in percentages. Let's say, right, to 2 decimal places. This is what you have. Therefore, your average growth rate, so let's just say average G is going to be equal to, so you want to add all of these and divide by the number of items. So it's going to be 9.52 plus 0.00 plus 23.19 plus 8.53. So what is this going to give us? The average growth rate within that period, right? So which is a period of how many years you're dealing with? 1, 2, 3, 4. Those are the 4 growths that you are dealing with there, or the 4 items, right? So this is the sum of all of this here, right? And then we want to divide that by 4. So it's 10 point something. So you're expecting that these dividends roughly grow at that rate. So let's say 10.31. Right. So given that now, we know that the price of a share should basically be what? The next dividend. So which is D1 divided by KE minus G. Right. This is what you basically get from that there. So what is our D1? So our D1 is our next dividend from 2022. So which means now we have our 2022 dividend being 369. So if we grow this dividend by the growth rate there, what would it give? What would that give us? Let's do the calculation quickly. So D1, if you're interested in the formula, it's going to be D0, which is the current dividend, and then you are multiplying that current dividend by 1 plus G, which is the growth rate, right? So which is basically going to give you 369, right, times what? Times 1.1031, right? That should basically give us the amount there. So what is the amount? Let's quickly do that there. So this is going to be 369 times 1.1031. Right. I must apologize for taking a bit of time tonight, but I'll be done by 9:30. So if there's anything that's not completed, we'll complete on the next session. I don't want you guys to sleep here. So it's 407.04 divided by, so our KE is given there. Let's see how much our KE is. So I'm quickly going to the question there. Right, so our KE is 15%, right? I think we read that together. So if it's 15%, then it's 0.15, then minus what? Minus our G. So our G is 0.1031, right? So based on our calculation now, we can estimate the value of this share to be 407.04. This is the value per share, right? Sorry, no, it's not per share. I'm going to explain that quickly, right, what it is. But when we normally do this, it's going to be the value per share, right? But so this is the value. So let me explain why this in particular is not the value per share. Because if you look at the dividends that we are fetching here, these are not dividends per share, right? It's dividends in total. So which means our calculations should give us the value of the shares in total. So this is basically this times 1,000 because we removed 3 zeros on that. So that should be 8,678,891. That's basically it there. Rands. So we are done now with B. Let's look at C. Let's look at C. Part C, as I indicated, this is very popular with, I'm sure you have seen it already in your tests. But maybe if you have seen it in your test, there's a likelihood that it might not come out in the exam, right? So you might also want to focus on these other methods that we have, that we haven't used, right? You want to keep those in check. Right, so in terms of earnings multiple now, before I even read the question, things that we need, number one, we need maintainable earnings, right? Maintain earnings, this is where you get the marks from. And then from there, you want to get your comparable price earnings ratio, and then you do your adjustments there on your comparable price earnings ratio. So this is a very simple method. Watch carefully and see what we are doing, right? It's very, very, very simple, right? So in answering these questions, ask yourself, okay, what are you looking for? What's your intention? So I already made my intention clear now. 2 items that I need: maintainable earnings. Sorry, it should be earnings. Why did I say marks? Maintainable earnings, right? And then after you've calculated your maintainable earnings, you basically want to get again your your price earnings multiple. Right. So the starting point of your maintainable earnings could be your earnings, right? Could be your earnings. But we want to analyze now what kind of earnings those are. Right? You want to analyze what kind of earnings we want to take into consideration. So the theory behind this, if you remember well, we're saying this method is suitable if you have the previous year's earnings, right? If you have got access to this information. So, and then we're saying it's a company that has been in existence. So these are the previous earnings. So the first thing that you want to do in getting your maintainable earnings, you want to make adjustments on these earnings for abnormal items, right? For spikes, I think those will be basically spikes, which is a large increase or a large decrease on your earnings, which is something that you don't expect to reoccur, right? Which is something that you don't expect to reoccur. And then you basically want to make use of that. So I'm just going to do copy some figures there, right? So we're going to be taking from 2018. So that's what I'm writing on the Excel spreadsheet, which you can see, 2018, and then 2019, 2020, 2021, and then 2022, right? And then I'm just listing the earnings there. It's 472,534, right? And then 498 and 578 and 660. That's the last one there. Right. Let me take you there quickly so that we are all sailing in the same sheet. So this is all that I did there. So these are the years. Right. So we want to make use of these here, make use of this data here to get our maintainable earnings. That's basically what we want to do. So which means, what are maintainable earnings? These are the earnings that we basically expect to keep occurring. That's where we are saying on average, and these are our maintainable earnings. So which are the earnings that we can maintain, that we are likely to get, right? That's maintainable earnings by definition. So let's go back to the scenario now. We want to look for the spikes, right? We want to make adjustments there. So as we're reading through, there's one adjustment that I already picked up, right? The chief executive officer of HealthBar is paid a salary that is at least 400,000 more per year for him when compared with the market related salary. So we want to make an adjustment on that one, right? Why so? Because should the shares be purchased, his salary will be adjusted to be market related. So let's say with this, let's just say CEO salary, or let's just say salary. Right? Let's just say salary. So we are making an adjustment for a salary. Why so? Because it's an unusual item. it's an unusual item and we don't expect it to reoccur once we've sold the company. So earlier I said earnings are, is it a question?
Sorry,
Yes,
where did you get the earnings?
the earnings. Okay, let me go back again and then we see the earnings. So this is where I got the earnings, these amounts here, net profit. That's the earnings. And then
All right,
I was
thank
about to, I was about to say, you must remember that earnings are profits after tax, right? Profits after tax. So this is your net profit, net profit. So your net profit is your net profit after tax, right? That's it there. So the CEO, we are slashing down his income by how much? By 400,000. So let's slash that down. So this is going to be a deduction. So minus 400, minus 400, minus 400, minus 400. Oh, sorry, we are adding, right? My bad. We are adding this back because it was a deduction, right? So it comes as 400, 400, 400, 400, 400. So we are adding it back because it was deducted to arrive. It was an expense deducted to get to your earnings, which is your profit after tax, right? So hence we need to add that back because it's an unusual item, right? Then we are not only doing that now, because your earnings are profits after tax, then which means we need to factor in the tax effect on this salary, right? Because that salary was subject to a tax deduction, right? It was subject to a tax deduction. Right. So what's the tax effect there? Our tax rate is 27%. Right? So it's gonna be 1 minus 0.27 times 400, right? So 1 minus 0.27 is 0.73, right? 0.73 times 400, right? Sorry, I'm being interrupted here with these phone calls, right? Sorry about that, okay? 0.73 times 400. So we are factoring in the tax effect of that. So if this is an addition, the tax effect will have to be a subtraction there, right? So what is it? It's going to be 0.73 times 400. So that's what you get there. Oops, sorry, no. Hey guys, I think I'm tired now. We do 0.73 if we are going to take the salary as it is, but if we will show the working as it is, then we put the tax the way it is. Why isn't someone correcting me now? So the tax is gonna be 0.27. Sorry. At least we saw this before it went far. So 0.27 times 400. So that should basically give us our 108 there. Right. So the effect of this, if you look at 400 minus 108, basically gives you 292, which is the amount that you get if you take 400 and multiply by 0.73. So you have that option. If you don't want to show this here, you can simply write there 0.73 times 400. So that can still work out. All right, let's see what other adjustments you have. So why are we doing this? We are doing this because of the tax effect of this adjustment, right? We are doing that because of the tax effects there. All right, let's see what other adjustments we want to make there. So which is adjustments on the earnings, right? So nothing there, including the property. You already dealt with this. It does not affect our earnings. And then we've got 40 million there, right? Nothing else, right? Nothing else.
Sorry.
Yes, ma'am.
So if the salary is negative, the tax effect is going to be positive.
Yes.
Okay.
So circumstances under which the salary would be negative would be a situation that is opposite to the one that we're dealing with. where we are saying this CEO is being underpaid. So we might want to increase his salary, then which means this salary will be a deduction if we're increasing his salary. So it's going to negatively affect our earnings. Then the tax effect is going to be positive. It's going to be moving in the opposite direction there. Right. So now, because there's nothing else, so what we will be paying attention to in a normal scenario would be issues like government grants, you see, those things that we don't really expect to reoccur. ETC, the scenario will basically let us know, right, what it is that we expect not to keep reoccurring. So now you want to see if there's a trend now. Now that we have our earnings, you want to see if there's a trend. So either an increasing trend or a decreasing trend. So if there's a decreasing trend, it means it will be decreasing, right? Going down. Your items are basically going down, 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 down. Your earnings are going down. Then if it's an increasing, it will be going up, say 764,826, and then 8 something, 879 something. So if it's an increasing trend or a decreasing trend, your maintainable earnings basically becomes the last amount there, right? And then bear in mind, you can arrange these things any differently, right? You could arrange these things differently in terms of your 2022, 2021, likewise. It doesn't matter how you arrange it, right? But you simply need to understand there what's going on. So here, because there's no trend, then we need to average these things. And then we are not only averaging them, but we are weighting them. So we want to find the weighted earnings, right? So this is where you need to be watching out. Right. So the formula there, if you want to show the formula for your weighted earnings, you are taking 764 times 1. I want you to notice something. 826 times 2 plus what? You can continue now. 790 times 3 plus what's next? 870 times 4 plus what? 952 times 5.
Times 5.
Right. Dividing that by 5 plus 4 is 9. 9 plus 3 is 12. 12 plus 2, 14. 14 plus 1, 15. Right. Let me put it in writing. So you are dividing that by 1 plus 2 plus 3 plus 4 plus 5. Simple. Okay. So let's close that bracket there. So what will that give you? That will give you your weighted earnings there. So let's do the calculation. So I think it will be faster. 764 times 1 plus 826 times 2 plus 790 times 3 plus 870 times 4 plus 952 times 5. And then we said we are dividing that. So that gives us 15, this one here at the bottom, right? So we are dividing that by 15. So maintainable earnings is equal to, let's take this maintainable earnings. So our maintainable earnings are these ones here. These are our maintainable earnings. Right. Now we are concluding this one. We've got a minute left, but just give me 3 minutes to conclude this one. So now, in terms of our maintainable earnings, you therefore want to check and see, first of all, how much are we buying in that company, right? Directors are constantly making an offer to purchase an unlisted company. So if they are purchasing an unlisted company here, the assumption is that they are buying all the shares, right? They are basically buying all the shares, it looks like. So if they are buying all the shares, then there is what we call a control premium. There is what we call a control premium. right? What is a control premium? It's basically the gain that you get from purchasing shares that are, or the gain that you get from of being able to control a company, right, by virtue of the shares that you are buying. So remember our range, somewhere between 10 and 15%, right? That should just about be it there. So if it's a control premium, then it should add to the value of this company, right? It should basically add to the value of this company, because you are saying there is more that you pay for a company that you are going to control, right? There is more that you pay for that. There is a fee, right? And then another problem that could arise now, what you could, one of the common things that you should include here would be, again, the marketability of these shares. So let's call it marketability discount. So we are estimating the value of this company, right? And then we are saying what sort of things could increase the value of this company and what sort of things could decrease the value of this company. That's what we are doing here at this point. So we are saying the things that could increase the value of this company is the control premium, the fact that the acquirer wants to acquire control. He basically wants to put out other shareholders and become the main shareholder there. So there is value in that. Marketability, this is a discount because remember, you are buying a share that's not listed in the stock market. So you are unable to sell this one anytime, right? So we want to give you a discount for that, right? So those are the ones that you will usually have there, right? And then you get your adjusted maintainable earnings. This is what you get there. So let's say adjusted maintainable earnings. Let me write it as MAM because of time, right? And then now you want to deal with your price earnings multiple, right? Your price earnings multiple. So where do you get that from? So you get that here, right? This is where you get that there, where they said, let's see. Right, so the directors of WorldCheck indicated the price earnings ratio of WorldCheck should be used as a proxy for the price earnings ratio in evaluating health bar. So what's the price earnings? Therefore, what would be the price earnings for WorldCheck? Then we can simply fetch it here. So the net profit for WorldCheck was 65 million, right? So which means that is the earnings. Then what's the market price? It's basically 1,300 or 1,300 cents, right? So which means how you go about this calculation now, it's gonna be your 1,300 cents. This is per share. So in rands, this is basically 13 rands, right? So 13 rands times 40 million divided by 65. That would give you, that's a basic ratio there. That would give you your price earnings ratio. All right, let's quickly do that before you guys fall asleep. This is just the last part. So we say this is gonna be 65 million, and our 65s are put, our millions are put in thousands here, and then we are multiplying that by 13 to give us the total value there. And then because it's price divided by earnings, so this is the price on top, then the earnings 65 million. So that's what we are basically doing there. All right, so let's see what that gives us. So this is going to give us 65 times 13 divided by, okay, I hope I wrote that correctly. Sorry, let me just check. Why do these figures look the same? Oh, sorry,
I think you have
40
million, yes.
40, yeah. Look at what I wrote again here. So, okay, so it's 40 million, right? We are going to correct times 13 divided by 65 million. So it's your 8 there. So we said it's 40 million, right? Here. 40 million. And then let's see if it's matching. Yes, 40 million, which is the number of shares, times 13 rand per share divided by 65. Then that gives us the earnings. So at this point now, you want to adjust your price earnings ratio. So this is what you will definitely get. You will definitely get this at undergrad. So in terms of the adjustments, now you are looking for situations that differentiate between WellTech and HealthPath. So WellTech has got a price earnings ratio of 8. But because we are dealing with HealthPath, we want to look for the specific scenarios that only apply to WellTech. So what kind of scenarios would those be? You want to look at, say, maybe if they've got a skilled workforce, that will be an addition. Maybe if they've been in business for a long time, that's a +1. If they've got a good reputation, a +1, bad reputation -1. But remember, we're saying at this point, your range is take a range between -3 and +3, right? Take that kind of range. So in this instance, we don't have anything. We don't have any information on that. Right? We are not given any specific information on that. Right? There is nothing specific. I don't see anything specific. But because this is practice, let's just say now we are working with a scenario where there is well-trained workforce. So you can come then say well-trained workforce, right? So we said you're looking at a range between 3 and -3. So if it's a positive, then you can put, if you believe it's a strong enough point, you can put 3. I'm gonna go with 2 here, right? Then let's just say there's a problem of labor turnover or employee turnover, high employee turnover, right? It means that a lot of employees are leaving, right? We can put that as a negative. This is very bad. Let's say -3, right? And then let's just say the scenario says they have a good reputation. A good reputation, we can give them, let's give them a 2. Right? So if you are taking my solutions, then you want to come and adjust here and put maybe 1, put 3, however way you feel it, right? The principle is a negative must be a negative, a positive must be a positive. So we add these up together. Right? I'm almost done. So we are done now. All right, sorry about that. We are finishing. So you are just multiplying to get the value of the company now. You are simply multiplying those 2 figures. Then the last thing that you'll probably do there, right? The last thing that you'll probably do there. So this is, let me multiply. It's 9, that amount there times 951. It gives you that value. So the one other thing, maybe they could ask you to find the value per share, then you divide this by the number of shares. That's the only thing that you are doing there. All right.